Welcome to Slicing the Profit Pie, a visual guide to mastering earnings per share, or EPS, and reading stock financials like a pro. When you invest, you are buying a direct claim on a company's future profits, not just trading letters. EPS is the single most important metric, showing how much of that profit belongs to your specific piece of the company. Think of net income as the whole pie, the total profit after bills. The shares outstanding are the slices the pie is cut into. Your slice size, EPS, is the portion of total profit allocated to one single share. To calculate EPS, start with net income. Subtract preferred dividends, as these investors eat first. Then, divide by the common shares outstanding. Total profit can be misleading. Company B made more total profit than Company A, but because its pie was cut into more microscopic shares, Company A's investors received a larger slice of $1.91 EPS compared to B's $1.63. Basic EPS only counts existing shares. Diluted EPS accounts for potential shares from stock options or debt conversions, which are like unexpected guests arriving with plates. The pie stays the same size, but your slice shrinks. Smart analysts look at adjusted EPS. They strip out non-recurring items, like a one-time sale of assets. They want to know how good a company is at its actual daily operations, baking bread, not selling the oven. Trailing EPS is the past 4 quarters, set in stone. Rolling EPS is a blend of historical facts and forecasted growth. Forecasted estimates project future earnings based on analyst predictions. If EPS is your slice of the pie, the PE ratio is the price tag the market charges you to buy it. It's calculated by dividing the share price by the EPS. The buyback illusion shows that a company can inflate its EPS without increasing net income by buying back its own stock. The pie doesn't get bigger, but fewer slices make your share look larger. EPS shows the final output, but ignores the required capital. Always check efficiency metrics like return on equity. 2 companies with identical EPS are not equal if one requires twice as much capital to generate it. The expectations game means a, quote, EPS depends on what Wall Street predicted. A company can report record earnings, but if analysts expected an even higher number, the stock might crash. You can build your own EPS calculator. Collect data from a company's financial statements and use these simple formulas in your spreadsheet to determine the final EPS. Follow these 3 golden rules. Always look at diluted EPS, strip out the noise for adjusted EPS, and remember that context is everything. Compare EPS to competitors and the PE ratio. You are no longer flying blind. You know how the pie is baked, how the slices are cut, and how to spot the illusions. You are now confidently pricing your share of the profits through fundamental analysis.